Greetings. It's Monday, January 9th. It's 11 a.m. and it's time for our webcast, which we try to do on a regular basis on Monday mornings at 11 a.m. So here we are. And we try to keep it to half an hour. I usually talk a little bit too much and don't leave enough time for questions, but I'll try to do better this year. That's one of my resolutions. Another resolution is to get over this pneumonia. I'm making a nice recovery from it. The cough's gone and the breathing's better. The only thing left is fatigue. So seems seems these days that I really need to get a life, because I take these long naps, and then when I wake up, I'm writing morning briefings or QuickTakes. So I hope things will get back to normal. I'm pretty sure things are going to get back to normal pretty quickly here. Anyways, let's get down to brass tacks on what we all care about, and that's the market. Let's look at the charts from the morning briefing. And this morning briefing is titled Good Start. It certainly was a good start last week. It turned out that most of that good start occurred at the end of the week on Friday, when we had a slew of labor market indicators that suggested that all in all, the economy is still creating jobs, yet we're seeing some moderation in wage inflation. So that was all greeted quite positively by the markets. And then this week, so far so good. We're starting out with an up market, with the bond yield kind of hanging around 3.5%, 3.6%. So that's all good. And I think the market is doing what I expected it to do back in late December. I said that the market should start to discount the possibility that we're going to have a really good CPI on Thursday. And so I think that clearly is the focus of the week. But we also have earnings coming out this week from particularly the large banks. And odds are the large bankers are going to be saying something like a hurricane is coming, or recession's coming. The consumer's looking pretty good right now, but we're expecting them to get weaker. But they're certainly not acting that way when you look at their balance sheet, and we'll look at that in a minute. But let's get into things here. This is an update on the market through Friday, and as you can see, we've been in a bear market. We still think that the low was made on October 12th in the bear market, which started January 3rd. A lot of bad things happened last year, but clearly for the market standpoint, the worst was not some of the geopolitical events, but rather the worst was some of the worst was really some of the events we had in the U.S. economy and global economy, particularly inflation. And as a result of that, we saw a remarkable pivot by the major central banks from ultra-easy monetary policies, which they conducted from 2008 through 2021. During that period, coming out of the great financial crisis, they were all concerned about deflation, and they were all concerned that they couldn't get the targeted inflation rate up to 2%. And so they gave us ultra-easy monetary policy. Then when fiscal policy kind of joined in with the monetary excesses, we finally got this surge in inflation, and suddenly they all had to pivot in a major way from unconventional, new normal monetary policies, ultra easy, to suddenly more conventional policies of central bankers, which is to fight inflation by raising interest rates, or at least to do so in a business cycle sort of fashion. And they've all made commitments to do whatever it takes to bring inflation down, even if that means a recession. So that certainly got the market spooked last year. More recently, the markets have held up pretty well in the face of the Fed raising interest rates, and that's got the Fed very frustrated. I'm writing a piece called Powell's Conundrum for tomorrow. And what's frustrating the Fed is the point of all this raising of the Fed funds rate is to tighten financial conditions, to slow the economy down, to bring demand down closer to supply, to bring down inflation. And that's what's frustrating the Fed here is the stock and bond investors just aren't listening. And they said so in the minutes that came out last week for the December meeting. What a difference. Well, we'll see if it makes a big difference. But I recall that it was at the beginning of last year, January 5th, that the minutes came out for the December meeting of 2021. And what did the Fed say there? They said they were getting ready to do quantitative tightening, and that they were concerned about inflation. Maybe it wasn't transitory, maybe it was persistent, and they became more alarmed about inflation, and the stock market started to understand that, and that's why we had this bear market. But here, the Fed has continued to warn that they still have a ways to go in raising the Fed funds rate, and yet look at the bond yields come down from 4.25% to 3.5%, and that's the same kind of conundrum Greenspan faced in the early 200s. You might recall that the Fed, I think it was 2004 to 2007, that the Fed started to raise the Fed funds rate by 25 basis points per meeting. And the Fed was just couldn't understand why the bond yields weren't going up. And Greenspan called that the conundrum, as subsequently called the Greenspan conundrum. And he eventually explained it as a glut of savings, global savings. And because of that glut of global savings, it was the foreigners that's fault for the financial crisis we experienced in 2008, 2009, because they were the ones that were keeping the bond yields and mortgage rates down and making credit available, even though the Fed was trying to tighten conditions. It was a pretty lame approach to tightening credit conditions because they did 25 basis points per meeting, so it was very predictable. Anyways, where are we now? I think we made a low here. We actually had down at this low and at that low, we had the sentiment in the stock market as bearish as it was back at the pits of the great financial crisis. And I know that there's a lot of pessimists who think it's just as bad now, or it's going to be just as bad soon. That's just not my reading of where we are now and where we're going. And so we had this rally, and then at the end of last year, Powell had his presser again and talked about bringing inflation down. And now we're kind of toying around with this 50-day moving average. We'll see whether we go above it. We think we might very well do so. Sounds like one of my puppies is here trying to get out again. We'll see if I have to take a quick break to accommodate Chloe. Anyways, the 200-day. Very good. I don't know. We'll ignore the 200-day moving average. As you can see, it took quite a dive during the bear market, and now it's recovering somewhat. But we're not technicians; we're fundamentalists. Every now and then we let you know what our friend Joe Feshbach is thinking, and right now he's thinking that the market's probably going to go higher in the short term here. Again, this week is the week we get earnings, and the market is expecting earnings. The analysts are expecting earnings to be down 0.1%. As you can see, this is the growth rate. And then next year, let's see, I got that right. Yeah, now next year I don't have on this. This is the S&P 400, 500. So the market is expecting a down number. And as we know, a lot of this past year's strength was in energy earnings. Take that out, and earnings were actually negative in a lot of sectors. Let me just let her out. How do you time these things? I don't know how she manages to do this exactly when I'm doing my conference calls, but then again, that's what she's doing. She's happy now. She's outside there. Let's look at the banks for a second, because we'll be getting, the banks usually, the major banks start off the earnings season. And as you can see here, the commercial banks deposits are kind of coming down a little bit. The pessimists, the bears, are just jumping all over that. M2, the demand deposits are all taking a dive here, what a disaster. Doesn't the Fed know this is happening? Well, just extrapolate the trend of deposits, and we're still above that trend by an M2 by about $2 trillion. So it's been my rather contrary view that there's actually a tremendous amount of liquidity in the system, and we can see it every time the news is mildly bullish. It could be a difference between a 0.4 and a 0.3 on expectations for some important variable, and it turns out to be a kind of a minor bullish signal and gets amplified into these huge rallies. So I think there's a tremendous amount of liquidity, and I think there's still a lot of fear of missing out. I mean, everybody wants to be the hero here and call the bottom. My heroic attempt here is to call October 12th the bottom in the S&P 500. And we'll see how that pans out. We've seen that some of that drop has been offset by selling off securities, treasuries, and mortgage-backed securities, and maybe some municipals. But you can see that loans are an all-time record high, which just doesn't jibe with the notion that we're going to have a recession. Though this tends to be a bit of a lagging indicator, as you can see here. So by the time this thing kind of is declining, we'll be in a recession. But the main point I want to point out is the banks are doing fine, at least in the traditional fashion of loans. I can't tell you about their trading desks. I will say that while some of these CEOs like Jamie Dimon and others at the banks during the third quarter warned about a consumer-led recession, they're certainly not preparing for it. When you look at allowances for losses, loan losses of loans and lease losses, this data comes out every single week. It's buried away in the Fed's weekly commercial bank report, and you can see that there's just a minor little increase here. I think it's a minor increase. You can read the morning briefing to get the exact numbers, but it's just no big deal. So I think the banks are not going to disappoint. I think the earnings, the analysts are always too pessimistic coming into earnings season, so there could be another earnings hook, or at least it's not going to be any worse than what the analysts are anticipating now. By the way, the fourth quarter is kind of irrelevant for thinking about the market. It's only relevant to the extent that it has an impact on these numbers, which is the analyst consensus expectations. Oh boy, I'm sorry about that. Got all these distractions going on here. That's what happens when you work from home. The analyst expectations got clocked during the third quarter earnings season when the guidance was pretty negative. So you can see these all kind of came down. But let's see whether the fourth quarter reporting season that's starting now has much of any negative impact on earnings. Obviously, if it does, then the markets may focus on earnings as a negative. But right now, the way the market's behaving is the jury's out on whether we're going to have a recession, whether earnings are going to take a dive. And meanwhile, the bond market's holding in pretty well. So there are people jumping in with the liquidity they've built up to buy these rallies. But I'm sure the pessimists will say this is just another rally in a bear market. That's not our position, but that's what makes markets so much fun and interesting. Another area where we're definitely contrary is a lot of our accounts have told us that we're just about the only ones they know of that actually expect earnings to be up in 2023. Well, maybe it's because we're one of the few that are in the soft landing or even no landing camp. We've just this morning I wrote about the no landing scenarios being sort of in that spectrum of soft landings. It certainly would be contrary if the economy grows 2% or more, if inflation actually continues to moderate down to 3 to 4%, if the Fed funds rate really did, not the Fed funds rate, but if the 2-year note is telling us that the Fed funds rate is going to peak soon, it would be contrary to conclude that the bond yield peaked at 4.25%. At least that's my reading of what the consensus is out there. But certainly 225 is contrary relative to 215. That's an increase. And I've seen a lot of people at 210, 200, even lower than that. Then they put a reasonable PE on that and they say that we're going to 3,000 is sort of the next leg down. Again, that's not our position at this point. The analysts, meanwhile, do tend to be optimists at heart and have to often lower their expectations. And so we're at 215, they're at 219 currently. That changes on a weekly basis. We're at 225, they're at 229, or 250, 253. And in this chart, which we monitor every week, you can see how the analysts are thinking relative to what we're thinking. And every now and then we'll come to our senses and change our numbers. And more often than not, we'll kind of stick with them. So the big event is the CPI. I mean, I guess, we could always have a big surprise on the earnings side, which turns out to be the big event. And it's doubtful it'll be to the positive side. If anything, it'll be to the negative side. But the markets are clearly focusing on the CPI that's coming out on Thursday for December. And as you can see, we don't have a lot of things to go by, but gasoline prices, this is the 4-week average, has taken a dive here. This is the national retail number, and it's a weekly number, so we can do a 4-week average. So it certainly has come down a lot during December. And then this is where what we did here in November came down a lot, as it did here. And then I think December is going to be another big contributor. Let's not forget natural gas. Natural gas futures do matter. They do have some impact on things like propane, the consumers use, heating houses, and also production of electricity, which I think the CPI for electricity has been like up 12% on a year-over-year basis. So that could very well moderate as the price of natural gas has come down quite sharply. And by the way, Europe, speaking of an optimistic scenario relative to a pessimistic scenario, I was right there with everybody else saying that, if there's going to be a recession anywhere, it definitely was going to be in Europe because of the energy shock that they experienced because of having to be cut off from Russian oil and gas. And they scrambled, and they managed to bring in enough gas to be at 95% of capacity, last number I saw, for their natural gas storage. So that's an impressive development. Back to America, back to the US of A. Used car prices, the Manheim Index, everybody's become an expert on used car prices ever since used car prices led the way up here, and now they're leading the way down here. So if they led the way up, why can't they lead the way down for the CPI overall inflation rate? Meanwhile, a number that isn't going to be immediately reflected in the rent component of the CPI. This is the rent component of the CPI in November was still going higher. There's no signs of a peak here. It's got up to 7.9%. The Fed is very well aware about the issues with the primary residence rent measure in the CPI, that it reflects all current leases, doesn't reflect what's happening on the margin with new leases. But we do have Zillow and Apartment List as indicators of new leases. And you can see that this is December now, and we're down to 3.9% on the apartments. So that suggests that this is going to be peaking in the first half of the year and start coming down, hence 3 to 4%, working to the advantage of getting that inflation rate overall down to 3 to 4%. A couple of other inflation indicators that look pretty good when thinking about the CPI coming up here. Here's the ISM prices paid index in manufacturing, pushed ahead by 3 months. And you can see that it has a good correlation with good CPI, which includes durables and non-durables. And that certainly suggests that this is going to be coming down substantially this year. Then we got the problem in the services area. A big part of that is rent and housing. The Fed has tried to split that off and look at services excluding housing. Sometimes they're very data dependent, and sometimes they get lost in the data, or they come up with a view that turns out to be give too much weight to some thought here. And I think they may be in that mode right now, just really focusing on only a pretty small segment of the CPI, which is the one excluding goods, just services, excluding rent. But in any event, the overall CPI services, I don't know, it's not a great correlation, okay, but it certainly correlated on the way up here, and maybe it'll correlate down. So this is 12 months ahead for non-manufacturing prices paid index. And so that's pushed ahead 12 months. So sometime by the middle of the year, this should be turning down, consistent with what we just saw in rents. Meanwhile, on the labor market side, some of the strength in payroll employment, I think offset the impact of the pandemic on average weekly hours. A lot of people that were able to stay on the job worked for some pretty long hours, and you can see that coming out of this mini recession here, lockdown recession, we had this huge spike in the number of average weekly hours in private industries. And I think that as the pandemic abated, workers started to quit because the hours were too long, pay wasn't enough. And I think what we're saying here is that part of the reasons employers have had to scramble to hire people is to make it, to take some of the stress and pressure off all these people that were still working and able to work. So this is an offset. This is a 2% drop in average weekly hours. So it offsets a 2% increase in payroll employment. All in all, hours worked continued to go up, and they did, however, in December go down a little bit. The number that seemed to really get the market excited was average hourly earnings. There's two flavors of that. All private industry started back here. The production and non-supervisory workers started way back here. And either way you slice it or dice it, it's probably better to look at private industry for all workers. And we're down to 4.6%. So it's coming down, and there's no reason why it shouldn't continue to come down. But I do think that wages are going to be increasing faster than prices this year. Productivity has just been totally messed up by the pandemic. I think we just have to recognize the pandemic just kind of threw everything up into the air, and it's taken a while to sort things out again. But I think that's starting to happen. And I think this is the year that maybe we go from the what was called the new normal to the old normal. For a while there, it was the old abnormal, but maybe now it's going to be more business cycle like, where inflation is 3 to 4%. The unemployment rate is relatively low. The Fed keeps interest rates relatively high. The economy is resilient enough to handle it, and life goes on. This is our earned income proxy. If the pessimists knew about it, they'd probably use it, because this is average weekly hours times the number of people working, payroll employment, times average hourly earnings. So it's a good proxy for this number, which is wages and salaries and personal income. And that's through November. The December number was barely up. And that's in nominal terms. In real terms, it could actually be flat to down. So that's not a healthy number for a continuation of consumer spending. But I think that as we get into the new year, I think that we'll see more of this. This is wages in real terms rising, wages rising faster than prices. So real wages, I think, have in fact started to turn up. They had stagnated for a while there as wages didn't rise any faster than prices, and we had a wage price spiral. I mean, it may be too optimistic to believe that the wage price spiral is over, but I guess that's kind of what I'm saying, in which case we should be back on this growth path of 1.2% real wage increases. That compounds pretty nicely, and it's a good increase in the standard of living. By the way, this is one of my favorite charts for arguing against the progressive notions that real wages have stagnated for decades. I mean, they stagnated during the 80s and early 90s, but then they've been on this pretty good path of growing 1.2%, which is a pretty good approximation for what productivity has been doing, at least 1.2%. Another point for the pessimists is industrial production is probably going to be down in December. We know that from aggregate hours worked in manufacturing, and you can see that declined for 2 months in a row now. Maybe some of that is auto production, but that suggests that production is going to be down in December. Production is one of the 4 components of the index of coincident economic indicators. Payroll employment is also in there, and it's going to be at a new record high. It is at a new record high. Here's another area of debate with regards to soft versus hard landing. The services component or the non-manufacturing component of the PMI took a big drop here to 49.6, just below 50. The orders index was down to 45.2. It doesn't look very good, though. It's certainly nowhere near these kind of levels. But if you're a pessimist, you can project that that's where it's going. I would just point out to you that NM-PMI, non-manufacturing, includes construction. And we know that construction, especially single family, is in a recession. So that may be what it reflects. I wish that the ISM would put out a services PMI. I'm going to kind of reach out to them and say, can you folks do that? Just take out the construction component, see what that looks like. I don't think it's going to be as weak as what we're seeing here. It certainly doesn't jibe with our experiences when we go to the airports, when we go to restaurants, and so on. The football games are packed. Everything is packed in the services area. A good development here for the soft landing, no landing scenario is that this total construction spending in current dollars is flat. It's not taking a dive like this. Maybe it's about to do it, but kind of doubt it. There is some issue here with inflation. Inflation has obviously boosted things a bit. And we know that most of the weakness has been in construction spending of single family. Look at multifamily, just kind of offsetting some of that, but at least it's not kind of going down along with it. This is what I want to show you is that non-residential is at a record high. The public is going to be going into record high territory with all the spending on infrastructure and the like that Congress has appropriated. But this is kind of fascinating. This is the components of non-residential construction. Amusement and recreation is still going up. Lodging is still going up. Commercial all-time record high. Maybe that's about to roll over. Manufacturing all-time record high. Maybe the whole onshoring phenomenon and money to build semiconductor plants. Hard to imagine that that started, but this may very well continue to go up. Communications going nowhere. Power down. Healthcare's all-time record high, and transportation is popped here. So that's one of the reasons that the Atlanta Fed just recently revised up its expectations for non-residential structures from a negative number to a positive number. Well, once again, I've done it. I've talked too long. Let's do some questions here. If you get a slowdown if we get a slowdown in 2023, what does this mean for monetary policy, stocks, bonds in 2024? You know, I think the wonderful thing about our business is that markets tend to be forward-looking, future-looking, and they do a pretty good job of that. And it's quite conceivable that now that we're in 2023, the market is starting to think forward and beyond 2023 to 2024. As you know, we're big fans of looking at weekly forward earnings, forward revenues, forward profit margins, and those are the time-weighted averages of analyst expectations for this year and next year. Well, right now, the time-weighted average of this year, next year, for their estimates is almost completely giving 100% weight to what they think for 2023, but every single week we'll be giving more weight to 2024, and there's no particular reason, unless you're just a pessimist at heart. There's no particular reason to believe that 2024 is going to be a bad year. It should be a good year. As a matter of fact, when I look at the earnings numbers, I'm thinking of writing a piece saying that we actually have had our earnings recession. It happened last year. look at earnings excluding energy, and they have negative. Most of them have negative numbers on them. So maybe this is actually the recovery year for earnings, but that may be too radically optimistic for some. But just something to think about. But if we get a slowdown, which if you allow me to interpret as a soft landing with inflation coming down without a recession, then I think that's very good for stocks and bonds. Should be quite good for bonds. Stocks, well, we have a problem with valuation. Things aren't cheap, but maybe we have a rotation away from the expensive stuff to the cheaper stuff. I mean, industrials will actually look pretty good to me, given the money that's in the pipeline for building things in this country and maybe other places. Okay, Doak says hello. Hello, Doak. Oh, there you are, Doak. How do you think the inverted yield curve will resolve itself? Thank you. The inverted yield curve will resolve itself the way it always does. It'll ascend, and it'll ascend once it's clear that we're out of a recession, or we're out of a recession, an environment of fearing recession. I think that this time around, the inverted yield curve may not be signaling a credit crunch or a recession. Maybe partly that's in there, but I don't think those are going to happen. If that's the case, then I think it's going to be signaling that inflation's coming down. So if inflation really does come down without a recession, maybe that's what is the propellant for getting the yield curve to start ascending again. Kevin, what is your view on the U.S. dollar? You know, I've been promoting for quite some time the idea of overweighting the U.S. and that the dollar would remain relatively strong. I think there is an argument, at least for the next 6 months, to be made that there are good cheap values in Europe if they're not going to have a recession. I'm fundamentally against investing in China, but if you're not fundamentally against investing in China, China's had a good run here and may continue to have a good run. The pandemic is going to be awful for the next few months, but that pandemic wave will probably crest by the middle of the year, and the Chinese economy should continue to open up. But emerging markets are relatively cheap too. So all in all, for the US dollar, I don't think it's going down from here. I don't know that it's going to go up a lot. But you know, I've been pointing out that one of the reasons the dollar has been so strong is capital inflows into our bond markets have been absolutely awesome. And maybe that's starting to slow down, and that takes some of the upward momentum out of the dollar, which has already come out of it in recent weeks. CJ, do you have a view on default rates in 2023? Yeah, I think they're going to be very low because I don't see a recession. I assume higher short-term rates are going to hurt a lot of companies reliant on floating rate debt. Yeah, I mean, you know, I'm sure you know a lot more about that than I do, and I think you have to do your homework. In that case, companies that are going to get a rate shock this year certainly could be in trouble. And I've seen people do charts of zombie companies, how many more zombies there would be if rates stay here and they have to refinance. I don't think that there's enough of them to add up to a recession, but there's enough of them to cause you grief if you happen to be invested in those. Well, we did it. That's all the questions I had, and that's all the opinions I had this morning. Have a good week. We'll see how the CPI goes. We'll comment on it with our quick takes. Stay healthy, and hopefully the markets continue to move higher. But of course, that's not going to be the case. There's going to be volatility. But let's see how this week just pans out. Do it week by week. Thanks again.